Ever feel like financial statements are written in a secret code? You see all these numbers and terms, and your eyes just glaze over. What if I told you that in just 5 minutes you could learn the basics to decode them like a pro? Stick around, because we're about to make finance your new superpower. First up, the balance sheet. Think of it as a snapshot of a company's financial health at a single point in time. It's built on a simple, powerful equation. Assets equal liabilities plus equity. Assets are what the company owns, things like cash, inventory, and buildings. Liabilities are what it owes, like loans and accounts payable. And equity, that's the value left over for the shareholders if all the assets were sold and all the liabilities were paid off. So, when you look at a balance sheet, you're asking, what does this company own? What does it owe? And what's the net worth? A healthy company typically has more assets than liabilities, showing a strong foundation. Next, we have the income statement, also known as the profit and loss, or P&L statement. While the balance sheet is a snapshot, the income statement is a movie. It tells you how profitable a company was over a period of time, like a quarter or a year. It starts with revenue, all the money the company brought in from sales. Then, it subtracts the cost of goods sold, which is the direct cost of making the product. What's left is the gross profit. After that, it subtracts all the other operating expenses, like marketing, salaries, and rent, to get the operating income. Finally, after accounting for interest and taxes, you get the big number everyone cares about, net income. This is the bottom line. Is the company actually making money? The income statement has the answer. Last but not least, the cash flow statement. This one is my personal favorite because cash is king. A company can look profitable on its income statement, but still go bankrupt if it runs out of cash. This statement tracks all the cash moving in and out of the company from 3 main activities. First, operating activities, the cash generated from the company's main business operations. Is it bringing in more cash than it's spending to run the day-to-day? Second, investing activities. This includes cash spent on or received from investments like buying equipment or selling assets. And third, financing activities. This is cash from investors or banks, like taking out loans or issuing stock, and also paying dividends or buying back shares. This statement shows you the real-world cash movements. It tells you where the company is getting its cash and where it's spending it. A company that consistently generates strong cash flow from its operations is usually a very healthy sign. So, let's recap the 3-step process. First, check the balance sheet to understand the company's financial foundation, its assets, liabilities, and equity. Second, look at the income statement to see if the company is profitable over time. And third, analyze the cash flow statement to ensure it's generating enough cash to survive and thrive. Together, these 3 statements give you a comprehensive picture of a company's financial health. It's not about being a math wizard. It's about knowing what questions to ask and where to find the answers. You're now equipped to look at any company's finances with a more critical and informed eye. I hope this quick guide demystified financial statements for you. It's a skill that will serve you well, whether you're investing, running a business, or just want to understand the world of finance better. If you found this helpful, give this video a thumbs up and hit that subscribe button for more content that makes complex topics simple. Drop a comment below with any questions you have or what you'd like to learn about next. Thanks for watching, and I'll see you in the next video.